do the LLC, after talking with many attorneys, many CPAs, many people about this, what you end up needing to do is just get extra insurance on the property. So if you think about where your first line of defense is, when somebody is going to come after you, and the reason you have an LLC in place is because with an LLC in place, that creates a separation of church and state, basically, right? And so when that happens, somebody can't sue you because the LLC doesn't own anything and they can't get past there. Well, it's actually very easy to pierce the corporate veil. And what I mean by that is that if somebody can prove in court that your LLC is basically just an extension of you and you have commingled anything in between the LLC and yourself at any point in the future, it creates one little avenue for them to say, hey, look, this is all actually just acting as one single person anyway. So what I mean by this is that if you have an LLC, but just one time, just literally one time, you send an email from the wrong email account. Maybe your business account sends an email about a payment to your personal account, or you forgot to use your LLC business card for a business expense and you put it on your personal account. One time that happens and you open up the floodgates for somebody to come in and break that LLC kind of, protection. So ultimately what your fallback is insurance. And that, like what we've heard from many, many people is just get a lot of liability insurance, like almost more than what you need. And it might not cost that much more. Maybe it's $50 a year extra. Maybe it's $100 a year extra. It's basically what you'd pay in LLC filing fees and registration fees. You'd end up paying a couple $100 a year, to do all that anyway. Just overpay on your insurance, by like some margin, get some extra liability coverage. And then when somebody falls and trips and wants to sue you, the first line of defense is going to be the insurance company, and let their lawyers fight your battle for you.
Well said.
Done. So the question that Bart had, I think Bart also had a question.
Can you do commercial loan?
Can you do a commercial loan? Yeah, you can do a commercial loan for sure. With a commercial loan, you can do it in an LLC if you want to. But again, they're going to want, if the LLC doesn't have any income history, they're going to want a personal guarantee. So it's going to be pointless to do it in an LLC because you're going to have an LLC own it, but it's going to be personally guaranteed by you. So if something happens to the LLC, guess who's the fallback? You, right? So I think it's important, at least at this stage. And just so you guys know, all of our properties right now, not owned in LLCs.
Yeah.
No LLCs for everything. We just have a boatload of insurance, like a ton of liability insurance, more than we possibly need so that it gets covered.
Nice.
And good leases. Seriously.
Yep.
That's it.
Yep. So hopefully that's helpful. If that helps, let us know if that makes sense from what he was saying.
Or you say what I just said.
No, because you do it so nicely. I know. You think by now, as many times as I've heard you say that. But you're always the one with that. Okay, I'm trying to look at my list. If you have other questions, go ahead and throw them in the comment section. Actually, one of the things, why don't we talk about, while we're here now, Kirk, and I know Bart's on here, we can talk about the reserves, because you had emailed us and had asked us about the reserves. So Kirk and I got kind of chatting about that and figured it would be a good topic to talk about on the call tonight. Just because in general, I think it's something that a lot of people need to think about. The whole idea of cash reserves, that whenever, you are going to be going and getting financing on a property, the traditional banks are going to require that you have a reserve fund for your properties in order to even get the financing, right? They're going to want, that's their way of kind of protecting their investment in you, I guess, when it comes to you borrowing the money from them and investing in the rental property, because it is a little bit more risky potentially for them from their perspective versus you buying, the house that you're going to live in, especially if you own a house that you live in personally and you're also getting an investment property. That's a risk for them. So they expect to see these cash reserves. So Bart, you had asked about this, and Kirk and I got to talking about this idea, and Kirk has a background in REITs. Mm-hmm. When was that? Was that when you were in DC, or was that
like over 10 years ago? Yeah.
So right out of college, when he started working, he was working in investment banking for a bank outside of DC, and REITs that was where he focused, I guess.
Cut my teeth.
Yeah. And so it was interesting. We had this conversation, and I think it brings a lot of light into this. So we're going to talk a little bit about the idea that the more properties that you get, and your portfolio actually potentially means the less reserves that you need. So he's drawing a nice picture to be able to.
You see this? This is really
I know,
good,
it looks
actually.
really good. Look at you.
Yeah, look at this legend, just so you know. All right, so here's the deal, right? So what happens is in property, and this is actually a really cool concept, and so you're all welcome that we're going to describe this for you right now in such a pretty drawing with a pen. But so the concept here is that when you start out, obviously reserves and capital expenditures become a huge portion of what you have to do. And so some people factor them in as just a hard cost. They apply a monthly figure to capital expenditures, even though it's not a true cost, but it's kind of like, like they bank that money as they keep going. Other people just have reserves, right? So what I've drawn here are basically two different lines. So there's reserves, which are over here, and also on the y-axis here. So reserves in dollars, 6 months of reserves, 4 months of reserves, 3 months, 2 months, 1 month of reserves, or no reserves, basically. And then on the x-axis here, these are number of properties that you own. So the concept is, and the thought behind this is, and this is validated by a lot of REITs. In fact, if you actually do a lot of research on very big time investors and people who own many, many properties, is there gets to be a point, some sort of apex in the future. It could be different for different markets, but there is some sort of apex in the future, at which point having reserves because you have more properties becomes inefficient, becomes basically an inefficient use of capital. So what we're saying here is that when you have your first property, your absolute first property, your sole property that you own, you're probably going to have 6 months of reserves. In fact, when you get your second property, you're probably going to have 6 months of reserves. And your third and your fourth and your fifth, you'll probably have 6 months of reserves for each one of those properties going out. Because as you start to accumulate properties, there still is a high probability that at the same time, randomly, a lot of those properties could have large capital expenditures. You could have an AC unit blow in property 1 and a water heater in property 2 and a furnace in property 3 and a roof in property 4, right? So you have to keep that reserve fund fully allocated as you're starting to grow your account. Now look, this is why most investors don't get past this threshold, ultimately, because they get pigeonholed into this like bucket right here and they can't get past this.
And we have a ton of people in our, not necessarily our pro community, but just the rental rookie community as a whole. I get tons of, like, I have one, I have two, and I can't get over that hump. I can't get out of here.
There's a lot of things. I mean, it's not just reserves, but it's financing and it's cash flow, right?
But there's a lot of people that are in that boat.
Yep. But so what happens is that after you start to accumulate, now say 10 properties, right? Like you get to 10 properties or 15 units, now your reserve requirement starts to creep down. And so maybe at this point it gets down to four months of reserve requirement at that point for each property. I'm saying not for, one property, I'm saying for each of them. You can kind of cut back on your reserve because now that you get to a certain number of properties, the likelihood that you get massive capital expenditures in all of the properties at the same time goes down dramatically. And at the same time, 10 properties are generating, say, $200 of cash flow versus 2 properties generating $200 of cash flow. So hopefully you get my gist here. And what happens is that as you start to accumulate more and more properties, there becomes a point at which your capital reserves should be absolutely zero. So your capital reserves, say with 100 or 200 properties, again, it's going to be different for different areas and different properties, but at some point your capital reserves should be zero, meaning that you should not put aside money for capital reserves. Because at 100 properties now, let's say each property is generating $200, you're generating $200,000 of rental, cash flow with 100 properties, right? And so those $20,000 of
I was like, that doesn't sound right.
That sounds amazing. $20,000 of positive cash flow, and so that $20,000 can easily cover a lot of stuff, right? And so 1 month of no repairs needed, now you've got this extra $20,000. Then 2 months, you got $40,000. Okay, you're bound to have stuff break at 100 properties or 50 properties, right? So you can see why you should at least start gravitating towards zero reserves. But I would make sure that you have more reserves than you need to start with so that just in case the worst happens and Murphy's Law applies to you and your portfolio for the month or the 2 months where everything just kind of goes crazy, you have enough capital to kind of withstand it. But this like graph, this apex, I think does ring true that as you start to accumulate properties, your reserves start to go down.
Well, and then you can start rolling that money just back into acquiring properties and snowballing. And so I think that's how there is that apex, not only with reserves, but in the fact of really being able to grow at such a faster pace too, is when you don't have to necessarily start saving all that money into reserves and CapEx and those sorts of things. And you can really start rolling those into the acquisition of new property. And so that's really where the I guess, momentum goes for you to be able to grow.
Yeah, it's just the efficiency. It's like mass efficiencies. Like once you reach a mass critical scale, you start to basically acquire naturally through the free market some efficiencies in the number of properties that you own, and that helps you actually grow faster. So people always ask and wonder, like, how do the rich get richer? How do people who buy properties seem to buy just hundreds and hundreds of properties, like, instantly overnight? Well, it probably took a long time to get started with the first 10 or 20 or 30, but then you reach a point at which you have critical mass and you start to accelerate at a much faster pace. So Bart said, so the saving for all expenses plus possible repairs. Yeah, I think it would be different for different properties. I think if you walk into a property and you know for sure, hey, the furnace is, 15 years old, I would add that expense to like a reserve account. And I would just put it in there right away, like new furnace, put it away, right? So that you have it kind of earmarked on your, cash flow statement. You have it earmarked in an account. And then, on top of that, I would save 6 months of expenses. So that's what I would do.
But those onesies, twosies, when you're just starting and you just have a handful of properties. Because what you don't want is for, let's say, God forbid, you have a vacant property for a couple of months, and then while it's vacant, you have to repair your HVAC system.
You're 100% right. So
and now you've got the perfect storm, which does happen. When it rains, it pours, if we've learned anything, I feel like.
Yeah, no. And what happens is that, people, what they do is they save the 6 months of expenses, which is fine if the property doesn't get rented. But what if there's a major repair that needs to happen that then causes the property not to be rented for 6 months, right? So the furnace blows or the roof collapses. Now you've got to repair the roof. And while you're repairing the roof, the property can't be rented out. So that's why you have to have both. I would put both in.
Or you're mitigating mold in one of our properties.
Yeah, like what we're doing.
We're dealing with it right now on one of our properties. Luckily, we have great insurance, and
but that's why we buy extra insurance.
Right, and we have the insurance that actually pays us the monthly rent if it's not rented because of an insurance repair. But our property's been vacant. This repair started in September. And we're still working on it. I think it was September or October. But we're, at the end of it, we'll get a check that covers the rent for all of those months, right?
Yep.
So that goes back to having really good insurance and making sure that you
pay a little bit extra because
it can really pay off. So let us know if that makes sense.
This is the best graph I think I've
really
ever
good.
done. Yeah, it's really nice.
Good thing we recorded this part of it.
Oh, where'd it go?
Very good. Perfect. So if you have other questions, go ahead and throw them in the comment section. I think that was all of the questions that I had sent in to me ahead of time. And so if you have any other questions, throw them into the comment section. And if not, we will wrap up here in the next minute. So if you have another question, throw it in. I think Molly finally maybe went to sleep.
She was only down twice.
All right. So I think that about wraps it up for tonight. If you are listening to this afterwards, because we'll put what we did get recorded tonight in the pro area. If you have questions about anything that we talked about tonight on the live call, always feel free to reach out, send me an email. Send me an email anytime. Questions that you have, I'm, here to help you along the way. So anytime you have questions about anything, you just want, a second look at an analysis or something like that, definitely send it over. That's why we're here. And that's why you're a member of the pro community, so that you have the ability to get access to us. So thanks again for joining us on the call tonight. And we will see you in the community.